Welcome to the Bloomberg Australia Podcast. I'm Chris Bourke and I'm coming to you from Melbourne on Thursday the 5th of February. We're only 5 or so weeks into the year, and I don't know about you, but it already feels even more chaotic than 2025. So how are investors and markets reacting? But more importantly, how are our super funds holding up? To discuss that and a whole lot more, I'm delighted to be joined by a very special guest this week. Paul Schroder is the Chief Executive Officer of AustralianSuper, which means he heads our nation's biggest super fund with some 410 billion Australian dollars of assets under management. Paul, welcome to the podcast.
Well, thanks very much for having me.
You know, I can't really imagine heading into the office every day thinking, yep, I'm the man ultimately responsible for $410 billion of Australian workers' life savings. So my big first question to you, Paul, just how well do you manage to sleep at night?
Yeah, it is a bigger responsibility, but it's an incredible privilege as well. And the main thing is that the members of the fund, 3.7 million of them, have 2,200 people who work for them in 4 continents in multiple time zones. So whilst I do take my role very seriously and I care deeply about it, I'm not the only one who's doing this work on behalf of members, and we've assembled, because of our size and scale and skill, a really talented, very high caliber group across the globe.
Mm-hmm. Delegation's also a wonderful thing, right?
It's essential. Delegation and accountability, Chris.
Some people who maybe haven't been sleeping too well in the past couple of weeks could be a fair few of your 3.7 million members. We've seen some pretty wild volatility in global stock markets. The dollar plunged to its lowest in about 4 years. And everyone in my supermarket last weekend seemed to be talking about the price of gold crashing.
Yes.
At times like this, what do you tell your perhaps more anxious members, especially those that might be closer to retirement?
Yeah, well, people do get anxious, and I completely understand that. And I try to say a couple of key things. One is that over the long run, there are ups and downs, but over the long run, they're ups if things are well invested and people are compounding their earnings and staying invested. That's actually a truth. That's a reliable thing that over time, if you contribute, if you leave your money and it's being well managed, over time, compound interest and relative outperformance will lead to people having more money and then more choices. They'll be richer in retirement. If somebody's worried about particular things like the gold price, I point to the fact that we've got fantastic exposure to gold mines, and so the movements in the price don't really matter as much as are we in a position to make good money out of gold? Yes, we have. And I would just make one other point, Chris, which is if somebody had $25,000 in 2000, despite all of the things that happened, despite all of the Brexits and the horrible terrorist attacks and wars and invasions and all manner of debt crises, that's worth 4 or 5 times as much money today.
And I am curious, actually, on gold, now that you brought up the members' exposure.
Yeah.
So is that your main exposure to gold, the gold miners? You don't have like lots of bars stacked up in Lonsdale Street Tower?
No, we deliberately do not. And the reason we don't is that gold as a commodity, as an actual bar, doesn't have an income stream. So you're really just taking a punt on its price. And I understand people want to do that and they do line up to buy it. We much prefer to invest in things with both a capital increase opportunity as well as income. And so we've been intelligently invested in gold miners. Like, they say when the gold rush, best to invest in the shovels and the picks.
Yep.
Well, we are literally invested in the shovels and the picks, and AustralianSuper members are.
So I'm just going to break down AustralianSuper's assets
Sure.
to get a snapshot of what your members own. So I had a quick look at your numbers at the end of September, I believe, is the last disclosure. You've got about 25% of your balanced fund in Australian shares, about a third in international shares, and about 12% in bonds. The rest is largely a mix of unlisted assets like infrastructure, private equity investments, and real estate. Look, last year, your balanced option did underperform the wider industry. How are you going to ensure that the portfolio adapts to even more, perhaps, uncertainty this year? What will you be doing differently?
Yeah, that's true. The portfolio is diversified in the way that you described, and that's really important for long-term performance and for long-term earnings. It's really important for individuals of those 3.7 million members that they've got exposure to stocks here in Australia, stocks globally, bonds, cash, private equity, and a variety of assets. That's a really important. Global diversification is one of the most reassuring things about investing. It's also true that short-term relative performance was a bit off relative to some others, but long-run performance is tremendously good. The main driver of that is that when markets are concentrated, that is, lots of performance is happening in a very small number of stocks and the largest stocks. That suits passive investing, indexed investing, where people just put the money where it was yesterday. And the times have suited that type of investing. But that type of investing doesn't deliver people the most money over their entire lifetime. Active investing does, and we're an active investment house, so we make active capital allocation decisions on behalf of members. So I'm pleased to say to your listeners and to members listening that relative performance has been materially improving over the course of this year because of the changes that have been made and because the structure of the market is also changing. So it's really important for people to be globally diversified. It's very important to be able to buy a range of assets intelligently, and over the long run, that will mean people will be richer in retirement.
And a big chunk of those international shares that your members own are in the US tech space, and a big chunk of our super gains have actually been driven by those shares.
Yes.
Do you worry, like some do, that the AI trade is starting to look like a bubble? I mean, even this week we're seeing a bit of a rotation out of that sector in the States.
Well, it's a fascinating question. We always are always worrying about bubbles. So we're carefully and constantly watching rapid share price movements, changes in valuations, constantly observing earnings, and that doesn't have the characteristics of bubble about it by any of those kind of measures. There is one particular thing that your listeners might be interested in, and that is how much CapEx is going into these AI machines. There's probably been $500 billion invested across those entities that are really AI deep and rich. We have to make a lot of money to get that back, and that would be the question that we would be asking: is do the future earnings warrant this amount of CapEx? So to watch that. The second thing that you said there, which is really very important, is that we're looking for, and it's starting to happen, the opportunity for performance and earnings growth to spread beyond just that magnificent 6, 7, 8 or 9 to the broader economy. And that's starting to happen. That's a good thing because concentration is itself a risk and it does make the market more vulnerable. So the more that broadens out, the better. It also suits active investing more. So Australian Super members will make more money when that happens, and it is starting to happen. So we're very thoughtful about bubbles. We're watching those indicators really carefully. But look, AI is here, and there will be winners and losers, and our job is to try and more often pick the winners and less often pick the losers.
And speaking of the US, it was about this time a year ago that you and some of your larger rivals were preparing to head to the US for that major summit with Wall Street chiefs and Trump administration officials. Since then, it's been pretty interesting. We've had those Liberation Day tariffs, endless confusion on tariffs since. We've had We've had Venezuela, and for a while there we thought Greenland might have been next. We've also had the dollar plunge, and a lot of that was driven by Trump's own rhetoric. Do you still feel as comfortable investing members' life savings in the US as you did when you were getting on that plane a year ago?
Look, there have been a lot of things that have happened in the US, and they do combine. And people go, what does that mean in total? And I think that's an important question for people to ask. We remain completely convinced that some of the best companies in the world are in the US. The best earnings in the world are in the US. I'll just give you one, I think, compelling stat. If you had $100 and you invested in Europe in 1920, it's worth $19,200 today.
Yeah, but you'd also be 106 years old.
Yeah, well, yeah. If
you invest.
Hopefully we'll get to talk about retirement and how to spend money as people live longer, healthier lives. But if you had that $100 in the US and invested in 1920, it's now worth $104,600, like 5 times. That economy knows how to make money. And so we're committed to it, but we're coming to it from 30 or 35% of the portfolio. Whereas a lot of those who are getting a bit nervous about the US have got 75% exposure and want to dial back. So no, we've been watching very carefully, and it is a fact that you've got to think about the economy and also all of the social complexity and troubles and confusion that comes out of there. But in aggregate, it remains a very good place to invest.
So have you trimmed exposure at all?
I'd probably describe it more like we don't think about geography as much as we think about sectors and securities. And so we are constantly thinking about how we should diversify. And, I think over the medium term, I think our interest in Asia will grow.
So we've been talking a lot about superannuation assets so far, and it's widely acknowledged that the industry has done a brilliant job of accumulating assets over the past few decades, with the industry now holding the latest figure was 4.5 trillion Australian dollars of assets, which includes about $1 trillion of self-managed investments. But we've now got almost 3 million people planning to retire over the next decade. How do you think Australian Super and the wider industry has done in preparing those workers financially for retirement?
Yeah, all of those numbers that you just said are really important. So I think the first thing to acknowledge is that very forward-thinking policymakers, associated especially with the Keating government and the ACTU and the industrial parties, created the superannuation system that we have today. And that was a very forward-looking piece. Like whenever I go to anywhere in Asia, the US, the UK, everybody says, how could we have Australia's system? Like without a doubt, it's people come to Melbourne to talk about it. So we should first of all say it is an amazing achievement that there's that many $1 trillion put aside in a system that's very successful. But we've been very successful at, as you say, the saving side, the investing side. What we haven't been very successful yet is the spending side.
Yep.
So how do we get to the point where people feel much more comfortable spending their own money in retirement or partial retirement or half? I kind of like to reinvent the idea of retirement because people don't do what they perhaps used to do, and it's not really gold watch time anymore. People move in and out and backwards and forwards to and from work and often end up volunteering or looking at, like there's a lot of aspects to life after you've left full-time work, if you ever had full-time work. But I think the industry and government together needs to reflect that this is not a product issue and it's not a market share issue. It's how am I going to live my life in the third of my life that's going to be made up of not working. And I think this is going to take quite a mind shift, which is to say, how can we make that simple for people? How can we make it easy to move in and out and backwards and forwards to work? How can we make it like Some people just want to be able to have more control over their time because they've been a slave to the rhythm for 40 years. Some people love their work and would like to keep doing it. Some people hate their work and would love to stop tomorrow. Some people aren't physically able to do work they used to love. And so I think we've got to be much more – it's actually easier in the savings phase because you just say, okay, 3.7 million people, if you send us your money, we will invest it well for you and we will grow your balance. Mm-hmm. That's quite easy compared to – every single person's situation is different. Everyone's household is different. You might be worried about inflation. Somebody else might be worried about running out of money because they're going to live a long life, they think. Some people are worried about market movements. Some people aren't.
Yeah.
And so there's different risks. They're very individual.
How worried are your members about retirement? What do you hear from yourself?
Well, one thing that just as an aside, like I think quite an important aside that you might not think about is that 60 or 70% of people are worried about filling out the form for the age pension. Most people, about 30% of people will end up fully self-funded, and about 30% of people will be fully on the age pension, and the rest will be some mixture. About 60 or 70% of people think that we should help them with filling out the age pension, and about 20% of people think we're already doing it for them, right. Which we're not. So people worry about the mechanics of it, for example, and put off the age pension, or they put off having an income stream because they don't want to say that they're about to retire. So people worry about markets moving, they worry about cost of living, they worry about inflation, and they probably don't worry about as much the rate change that's happened this week, but they do worry, is that going to turn up in my deposit? Am I going to get the upside of that? So, the thing, Christopher Pine was at the press club yesterday just saying, we've just got this kind of cartoon stereotype view of older Australians. And older Australians are as diverse and as interesting and as annoying and as challenging as every other human being.
Yes, that's a very good point. And on that point, say I'm retiring in the next decade, just asking for a friend, and my fund is AustralianSuper.
Yep.
What kind of advice can I currently get? About what to do with my money?
Fabulous. Well, not as much as you should be able to get.
Yeah.
So there's a fabulous piece of legislation that's sort of still caught up in the Parliament that would help funds provide more guidance and more help. Mm-hmm. And that's how we like to think about it, guidance and help. Advice sort of comes with it, a lot of formality and a lot of set up in FOFA, 15 years ago, blah, blah, blah. But really what people really want is help. Will I have enough money? What should I do with my money? And lots of things we can help you with, like what should I do with my investment choices? Does my insurance still apply? Depending on my age? There's plenty of things we can help you with. How do I do a transition to retirement? But sometimes the laws are such that you have to do very, very formal things with people that are more expensive. So I'd really like it to be the case that if people are acting in people's interests, then they should be able to, I definitely should be able to help them get the age pension. Definitely should be able to say, actually, where you're invested is pretty okay for you based on where you're up to. Do you own a house or not? That's going to be relevant. Do you have a partner or not? That's going to be relevant. Do you have dependents or not? There should be just some very simple questions and simple answers where we can just give people reassurance or at least guidance about what else they could be doing.
Yeah, we did a feature recently on that kind of that big gap in financial advice in Australia, and how Wall Street firms and other players are kind of starting to take advantage.
Yeah, right.
They see that opportunity, and even closer to home, we've got platforms like Hub24, which are more advisor focused. Are you seeing more members leave AustralianSuper for those kind of platforms?
Yeah. I think just to put that into the big sweep, the point about guidance and help and advice is as a big unsolved problem. It's its genesis is a lack of financial information and knowledge, right? So we're generally speaking, as a community, we don't really have very good financial literacy and financial grasp of things. And that's the big problem. If more people knew a little bit more, then there'd be less opportunity for people to make missteps or to put things at risk. So the central problem here is we should be helping people understand things more, and we're terrible as an industry. The finance industry is brilliant at having acronyms and 3 terms for everything. Like we just don't speak straight. So that's our fault. The second thing is that we need to invest more heavily in people. They're just their basic understanding of even percentages. People it's very simple, straightforward things for people who work in the industry. We take for granted that people often don't really even understand how percentages work. So we could help people a lot more there. And then that throws open the opportunity for people to move into that gap in order to make money out of that. But our dream at AustralianSuper is to make money for members, not from members. And so I think that you'll see more and more from us, but not just us. I think working with the Super Members Council, which is all of the profit to member funds, we're going to be putting a lot more effort into helping people just understand their own super and how it all works so that they can feel more confident about their super.
Okay, I think we've covered a fair amount of ground today, but to finish, I'm gonna go out on a limb and ask you what's your big call for 2026?
Yeah, that's that is a very difficult question. Thanks very much for the opportunity to talk about these things today. My big call for 2026 is that staying invested in growth assets, even when things look tough, is the best way to make wealth for your long-term future.
Paul Schroder, thank you for joining us on the Bloomberg Australia podcast.
It's been delightful. Thank you.
If you found today's conversation insightful, be sure to follow the Bloomberg Australia podcast wherever you listen, and check more reading on Australia's people and politics at bloomberg.com. This episode was recorded on the traditional lands of the Wurundjeri people. It was produced by Paul Allen and edited by Rebecca Jones and Ainsley Chandler. I'm Chris Bourke, and thanks for listening.